Hey there, students. My name is Nathan, and I am a tutor for Chegg Tutoring. Today we're going to be talking about declining balance depreciation. Now, I'm not sure if you've heard of this before, but the reason why they call it declining balance is because you depreciate the asset a lot more in the very first few years, and over time, the balance in that asset will go down. And so you're going to go ahead and depreciate it less in the later years. That's why they call it your declining balance. Because over time, your asset will be reduced by the depreciation. In the later years, it'll be a lot less than it was in the earlier years. Now, that's the reason why they call it declining balance. Now, if that still doesn't make sense, that's all right. Today we're going to go through a little problem to help you understand this process a little better. So here's how I set it up. On the left side, I gave you my 4-step method to getting the answer correct. Now, with my private tutoring, I tend to come up with a lot of step-by-step approaches that really help my students tackle exam questions. If you know the steps, you're more likely to get the answer correct. That's why I do it. So for declining balance, a simple method. Step 1, you want to determine the appropriate cost of the asset. Now, what does that mean? Well, there's a lot that goes into this, actually. It depends on if you have a piece of land, building, equipment. Now, with land, you actually don't depreciate it. But to determine the cost of the land, there's a lot that goes into it. Same with equipment, same with building, same with a delivery truck, any type of fixed asset. You got to figure out what is the cost of that asset. It's usually not just what you purchased it for. There's other costs that go into it. But a general rule of thumb would be to make sure you get that asset ready for its intended use. Whatever you're trying to use it for, any cost that you need to prepare that asset to get it ready for its intended use, usually that goes into the cost of the asset on the balance sheet. And you'll see what I'm talking about in the example here. But for now, let's go over step 2. Step 2, you're going to calculate the depreciation rate. Now, to get that, all you do is take 100% and divide it by the asset's useful life. That's it. So take 100% and divide it by the useful life, and that will get your depreciation rate, the rate at which you depreciate. Now, since we're doing declining balance, we'll keep it at that rate. But if you're doing the double declining balance, all you do is take that rate and you multiply it by 2. That's why they call it double declining. But for this example, we're just doing regular declining balance. Step 3 here, you're going to calculate that first year depreciation expense. So you take the cost of the asset and multiply it times the depreciation rate that you found in step 2. Step 4, you're going to calculate the book value of the asset. Take the cost of the asset and subtract out any accumulated depreciation. Now, accumulated depreciation is just the sum of all your depreciation expenses from year to year. Now, this is a simple 4-step formula that you can use. Now, when you practice it in a problem, you're still going to use that method, but I come up with a different type of approach over on this side. I use a little table that will help you keep track of the asset's book value and the accumulated depreciation. It just makes things a lot more easier and it stays organized. I know when you're on an exam, it can get kind of tense and you're stressed out, maybe you get forgetful of certain things. If you keep things organized in a structured manner, things just tend to go a lot easier. So let's take a look at a problem here and see if we can go ahead and practice this method. Okay, so here's the problem. On January 1st, 2012, Intertrode Inc. purchased equipment for $200,000. The freight amounted to $2,500 and installation was $6,700. Now freight, that just means transportation. So what did they pay to get the equipment shipped to their warehouse? And then installation, you have to install the equipment once it arrives. Determine the depreciation expense for 2012 and accumulated depreciation for 2013. That's important. I kind of threw you a curveball there. These are important terms to know. And I'll show you what I mean here. So let's go ahead and practice this little method here. Let's start with step 1. Let me go ahead and pull this up here. Okay, so for step 1, and I'll label it like this so you can follow along. Step 1, you're going to go ahead and determine the appropriate cost of the asset. Well, you purchased it for $200,000, but there's other costs involved. Whatever is needed to get that asset ready for its intended use. It's super important. So, getting it shipped, that's necessary, right? You have to have it shipped to the warehouse to even get the equipment. So that cost is needed to get the asset ready for its intended use. Same with installation. You can't use the equipment until it's installed. So both those costs actually go into the total cost of that asset. It's what they call capitalizing. They're capitalizing those costs and putting them on the balance sheet. So we're going to go ahead and add $2,500 and $6,700 to the cost of this asset here, $200,000. So determine the cost of the asset. So 200 grand plus 2,500 plus 6,700. And so the total cost of the asset here would be 92, 200, and 9,200. That's going to be your total cost of the asset here. And let me make sure I have. Yeah, that's correct. Okay. Now from there, we'll go to step 2. So we know our cost here. Now let's go ahead and get our rate. So calculate the depreciation rate. So just take your 100%, and you forgot to add a useful life here. Let's just say it's 8 years. 8 years of useful life for this equipment. So 100% divided by 8 years. And we'll get, if I'm not mistaken, this is 12.5%. So it depreciates at a rate of 12.5% every year. That's very important. Now for step 3 and step 4, we're just going to use this little table that I came up with. It'll go ahead and cover those steps. So the first date is when you purchased it. So on 1/1/2012. Cost of the asset, $209,200. Depreciation rate, 12.5%. And your depreciation expense is going to be multiplying your cost times your rate. So let me go ahead and calculate that here. Okay, so for that first year, your depreciation expense is $26,150. Now your accumulated depreciation, once again, is the sum of all those depreciation expenses. Now, since this is the first year, that's all you have, just that $26,150. So you just move that over, no big deal. Book value at the end of the year, well, you're just going to subtract the cost of the asset minus the expense. And that is your book value. So, $209,200 minus $26,150. So book value at the end of the year is $183,050. And now you just rinse and repeat. So what you're going to do is just move this book value down to the next year, because the book value of the previous year at the end is the same as the book value at the beginning of the next year. Once again, the book value you have at the end of a previous year is the same as the book value at the beginning of the next year. It just carries over. So we'll move this down here, 1/1/13. Cost of asset, well, it's changed now. Now we need to move this number down. So 183,050. Notice it's declining in balance, right? It went from 209,200 to 183,050. Depreciation rate, the same. Depreciation expense will be a little different now, right? Because your cost of the asset is less. Let's go ahead and multiply that. All right, I get 22881.25. Just round down there. So notice the depreciation expense is going down. So like I said earlier, you depreciate it more in the earlier years and less in the later years. Okay, and so your accumulated depreciation, well, it's the sum of these depreciation expenses. So you add 22,881 to this 26,150. And you get 49031. And since you already subtracted your depreciation expense in the first year, you've already changed the book value over here. All you need to do now is subtract your depreciation expense to get the book value at the end of the year. You wouldn't subtract the entire accumulated depreciation because that would kind of like be double subtraction there, and you don't want to do that. So just take 183,050 and subtract 22,881, and that's your book value at the end of 2013. All right, 160,169. All right, so can we answer the questions? Determine the depreciation expense for 2012 and accumulated for 2013. We can. Easy enough. All you do is just look in the chart. 2012 depreciation expense was 26150, and accumulated depreciation for 2013 was 49031. That's why this table is so important. You can go ahead and plug in, and you just look at the different columns, and most likely you'll be able to answer that question. Hopefully this was helpful for y'all today. My link is right down here if you want some more one-on-one help at Chegg Tutoring. Once again, thanks for watching, and I'll see you in the next video.